Hey, it's Lewis here and welcome back to the channel, and in today's video we're going to be analysing Diageo stock. We'll be using fundamental analysis via TIKR terminal to go through the numbers and the financials, and then we'll stick free cash flow into my DCF and we'll come to a fair value of their stock. Let's get straight into it. So who are Diageo? So Diageo plc is a multinational beverage alcohol company with its HQ in London, and it operates in more than 180 countries and produces in more than 140 sites around the world. It's the world's largest distiller. It was the world's largest distiller until it was overtaken by a Chinese company, Moutai, in 2017. It's a major distributor of spirits and the world's largest producer of Scotch whisky. Diageo itself is a primary listed on the London Stock Exchange and is a constituent of the FTSE 100 index. It also has a secondary listing on the New York Stock Exchange. Now let's have a look at the sales per business for Diageo, and for 2021, let's have a look. So spirits, beer, ready to drink, they're the three main sections. So spirits made up, that does not make any sense, 123%, I should have checked that before. But basically the majority of sales are spirits. The next big section is beer at 20%, ready to drink 6%. So this is mainly a spirit company. We do have a bit of beer, but most, because they do own Guinness as well, so that's one of the major brands. But these guys are mostly known for the spirits worldwide. Sales per region, now these percentages make a little bit more sense. So in the United States, the United States makes up 38%, over Europe and Turkey 13%, Asia Pacific 13%, Africa 11%, Latin America and Caribbean 8%, India 7%, and you can look at the rest yourself. But we're a global company, but the majority of the sales do come from the US. Not that surprising, massive market, but it is good that we do have that global diversification in sales. Now let's have a look at the financials via TIKR terminal for Diageo, and we'll start as always with the income statement. So financials from 2017 to 2021, 5 years worth. Easy to look at. Start with sales. So sales have increased over the past 5 years. Good stuff. Not by much though, as you can see. Slow, steady. Some years it's been up a bit. 2020 down, obvious reasons. 2021 back up. So the sales aren't going at a big rate, but you wouldn't really expect that, to be honest, because there's not going to be many more and more people buying alcohol and spirits unless it's a really small alcohol company which exploded. This is a really big and mature company, so this is to be expected, but you want them to keep on growing their sales by inflation at least. Then let's have a look at some of the other bits and bobs. We'll go to a net income. So over the past 5 years, decreased by, let's just say it's flat basically. So that's not a good sign. If the profit's flat, it means you want to pay a lower multiple of profit, so you will want to pay quite a low PE ratio for this stock essentially. If the net income isn't growing, you can't pay a lot for the company in terms of price to earnings. Simple as that. Otherwise you're just overpaying, simple as that. So that's something to bear in mind when you look at this company. Shares outstanding have been decreasing, love that. As long as they're buying back undervalued stock, it's a good thing. We'll decipher whether we are doing that later on. But that's for later in the video. Balance sheet time. So a little metric I like to see is the cash balance over time just going up and up, because you don't want the cash balance to be depleted and have nothing. It's a good sign that company can just produce cash if they don't know what to do with it. Sometimes it's a good thing. What's next? Long-term debt, I think it is. Not good. Long-term debt's doubled in the past 5 years. If they've had an acquisition, then maybe that's good, but as the sales have been pretty much flat and the profit's been flat, it doesn't look like they've bought a company to increase the sales, because it hasn't really worked out like that. So I'd want to know what have they used that debt for, and if it's been a good use of capital. Then return earnings over time have decreased, so it's something to look at there. Maybe something to do with dividends being paid when we're not making enough profit. Who knows? Something you have to dig deeper, because return earnings, you want that to be going up over time, right? And it hasn't over the past 5 years. You can see here the net debt figure's been going up as well, so that's not a good thing. cash flow statement, and let's have a look at cash flow from operations and capex. So these two figures combined make free cash flow. And just on top of my head, free cash flow has been increasing, and we'll come to see in my analysis at the end of the video to see what free cash flow we do predict for the next few years. My gut feeling is you don't want much growth. You maybe want 2-3% growth on your free cash flow, because the company can't prove that it makes big growth on its sales and profit, so you can't give it a high multiple. So yeah, solid company though, free cash flows here, but they're not growing much, so hence you need to pay less for the company. Onto the ratios, probably my favourite bit of the financial analysis. It tells me a bit more of a story of the financial statements, the ratios. So return on capital, lovely stuff, quite close to that 15% mark I like to look for, so love it. Decent gross margins, net income margins as well, fantastic in the 20s, apart from maybe the anomaly year of 2020. We all know why. Current ratio above 1, love it. Cash conversion cycle is high, probably to do with it being in what industry it's in. Payment terms aren't very good. No, it's inventory. That's what we hold inventory for a long time, but not too bad, because if you have whiskey, it's not like whiskey probably goes up over time in inventory, so it's probably to do with what type of products we do sell. Debt to capital is a little bit high for my liking, but something to bear in mind. But overall, interesting stuff. I think a few pointers from the TIKR financials here is the debt. You want to have a look at the debt. Debt's been increasing, and the debt's a little bit higher, what I'd probably like. The other one is low growth. There's not much growth with this business, so it's something to bear in mind. There's no doubt it's high quality though, which is something I'd love to see. If you'd like to use TIKR terminal yourself, click the link in the description below, and you will be able to get your account set up, and I'll get a bit of a kickback. So go ahead, use TIKR Terminal, great platform if you're analysing stocks. If you are enjoying today's video, then why don't you book in a one-to-one coaching session with myself? In these sessions you will learn how to analyse a company using fundamental analysis. As well as this, you will learn how to value a company using a DCF model. Value investing is the art of buying stocks which trade at a significant discount to intrinsic value. Value investors like myself achieve this by looking for companies on cheap valuation metrics, typically lower multiples of their profits, assets, and cash flow as well, for reasons which are not justified over the long term. Billionaire value investors such as Warren Buffett, Charlie Munger, and Joel Greenblatt have all used these timeless concepts to beat the market over the long term. No financial advice will be given on these calls, financial statement analysis and business valuation, education only. I will see you there. Now let's take a look at the genuine impact stats for Diageo, and we'll start with the quality metrics. So profitability scored very high, financial strength very weak, capital allocation very sound. So I think what this is showing is a highly profitable business, which we've seen. Financial strength is a bit of debt in the business, capital allocation wise they're doing decent. So yeah, a bit of a mixed bag there, but overall showing medium. Does make sense from what GI is showing. So now onto the value side of things. So it's looking expensive across the board. This seems pretty obvious. It's one of the most expensive stocks on the platform. Take that as you will, be careful essentially. Historical growth has been looking very solid as well. Revenue medium, earnings per share medium, dividend high, free cash flow to equity high. Maybe a bit different to what we're seeing on TIKR, but yeah, something to bear in mind as well. Interesting stuff there from Genuine Impact. Now let's take a look at my analysis checklist for Diageo, and let's go through a few bits. So market cap 104 billion. Don't know if that's in dollars. Let's have a quick look. Actually, is it in dollars? That must be in dollars because that's showing 83 there, so that's got to be dollars surely. So yeah, 83 billion pounds market cap, one of the biggest companies on the London Stock Exchange. Current price of 37 pounds per share, rounded because that's in pence, 37 pounds. PE ratio of 28 currently, earnings yield of 3.5. So profitable, high returns on capital using low leverage is my first pillar. I want to see if the company is making profit, making returns on capital in the business, and using a low amount of debt to do all of this. These three things combined are very important, in my opinion. Return on capital 5-year average is 15%, hits the mark, just a simple tick there, love it. Profit margins, as we've seen with the TIKR analysis, they're there as well. Not much to say, very profitable business. Free cash flow margin as well is a little bit lower, but it still hits the mark. Current ratio above 1, so they can meet the short-term obligations. Cash conversion cycle is high, as we discussed with the inventory. They hold a lot of spirits, whiskey, vodka, you name it. These things can last in storage for a long time, so this doesn't really matter. Some businesses will have a high CCC, some will have a low CCC, is what it is. I don't think it affects Diageo too much. Total debt to capital though is above the 50% mark, so this is something to keep an eye on with this company. You don't want them to keep on levering up, because debt is bad long term for companies, especially if it's too much and they can't pay their debts. That's how they go bankrupt. So the less the better. Proven ability to grow, so free cash flow and revenue have grown in the past 5 years, but net income and earnings haven't. As we discussed earlier, low growth business, we need to put a low multiple on this company, even if it is high quality. If there's not enough growth there, sorry, but that's it, simple as that. Great capital allocation, so debt has increased, we have decreased shares a bit, increased for dividend, so they're two good bits. Share count's decreasing, so as investors, for shares we own, we get a bigger piece of the pie. It's like the pizza slice gets bigger. Dividend growth as well, so it means if they're increasing their dividend, we're getting rewarded as shareholders as well. Good acquisitions. It looks like we had some write-offs, so something to bear in mind. But overall, 60% quality score, not too bad. I think a few things let it down, the debt and the low growth. But yeah, not too bad to be totally honest. There's a lot worse out there. Buy at a fair price. I like these below 20 just to get me interested. 28 and 34, way too high for me. And yeah, the DCF valuation for a 10% return, share price of £18 per share from the current share price, it needs to fall in half. Even still, after the last 6 months, the market has been in total carnage, to be honest. It needs to drop another 50%, simple as that. And even then, I'd want a bit more of a margin of safety on it, just in case the growth was negative. So yeah, we'll have a look at my inputs. Yeah, so my free cash flow inputs are quite generous, to be totally honest. I mean, 2022, I've put lower. I've used these estimates from marketscreener.com. If you put 3,000 just flat, no growth, you might come to a similar figure, to be honest. It won't be that much different. But basically what it means is Diageo, yeah, needs to fall in half for me to be interested. Good quality business, nothing wrong with it, but what can I say? Just needs to fall in half like a lot of companies do. It's one of those consumer companies, there's a few I can think off the top of my head, like your Pepsis, your Coca-Colas, Diageo. These companies, very high quality and stuff, but they haven't fallen yet like the tech darlings have. So give it time, these companies will fall. I want to do, get them in your shopping basket, but nothing else to say apart from low growth. You need to be paying a lower multiple. Currently, the share price is £37 per share. We're going to get to in COVID. That's always a good thing to look at. So 20th of March was the bottom. So £24. So it needs to go below COVID essentially. So yeah, it's what it is. Yeah, let me know your thoughts in the comments below. Do you own Diageo? Do you think they're a good company? Just let me know. So there we have it. That was my full stock analysis for Diageo. If you enjoyed today's video, then please subscribe to the channel. Thank you very much for watching. I will see you next time.
Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.